So on 2nd April 2025, what the US administration called the Liberation Day, which they termed as liberation from heavy imports, the new administration announced baseline tariff on 10% on all imported goods, which were effective from 5th April, and reciprocal tariffs from 9th April on individual countries subject to their trade deficit with the US. So the higher the trade deficit with the US and the higher the tariff that particular economic region was subjected to. So typically the tariffs were ranging from 10% to 49%. Of course, as the US runs the highest trade deficit with China, and there are also some geopolitical tensions between these two economies. The escalate, the tariff escalation to China was in the range of about 145%. So that's the most aggressive tariff which has been levied on any nation, which effectively means trade embargo with China for the US, because at 145% of the tariffs, it's simply unviable for China to export any good to the US. To India, given our lower trade deficit with the US compared to the rest of the world, our tariffs was lower, about 26%. But what it really means for the US consumer and US growth. So if you look at the chart on the left-hand side, so if you look at tariff as a share of imports, is the highest since 1910. So the tariffs are almost touching 24% as a percentage of value of imports, which leads to substantial inflation. So assuming a static import base, so of course, we are assuming that the destination countries will continue to be the same, but broadly, what it means is if US were to import the same composition of goods from the same countries, it can add about 1 to 1.5% of inflation this year. And given that it's a substantial, inflation, or in a way a tax on consumption, and given that US is a consumption oriented economy just like India, it reduces GDP growth by similar amount of 1.5%, and probably could even lead to a technical recession or to consecutive quarters of negative GDP if implemented fully this year. So that's the kind of impact that can be seen. So for example, if you would see the chart on the right hand side, which broadly estimates the impact of reciprocal tariffs on real GDP growth, as we can see in 2025, it leads to a total cumulative negative impact on the US of 1% and 0.4% in 2026. For Mexico, the impact is slightly lower because they are not subject to reciprocal tariffs for now. They are the old tariffs which the president implemented in early March are still applicable. So the impact is probably not in 25, but in 26. China, again, we see a major impact in 26 as well, because there's an assumption that China will, unleash some fiscal as well as monetary stimulus. Broadly, what we see, we are seeing major impact across all the economy. So what does it mean for the global markets and for central banks? Of course, if we were to see this kind of inflation, which in a way, given that it's coming from tariffs, is largely a tax on consumers, it is leading to potential slowdown. And what is in a normal world, and in a static world, probably a higher inflation in the US would have meant higher interest rates in the US, and that would have meant higher dollar flows and probably strengthening of dollar. What really happened as a result of this announcements was actually dollar weakened. One of the reasons was that, given the very aggressive and very volatile tariff situation, there is a perception amongst market participants that if these tariffs were to be implemented as they are, it could lead to major slowdown in the US eventually. and probably would lead to more aggressive rate cuts from the Fed. So because the first order impact will be inflation, probably the Fed will not be able to respond immediately. But by the time Fed responds and that whole effect of inflation really follows through, Indian economy could lead towards the US economy could lead towards a significant slowdown, and that's largely changed the reaction function on the dollar.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.